We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. I'm Gabe Johansson. I'm here with Mike Nuss and Trevor Howard, and you won't believe it, but Dane McKinney.
Dane McKinney's in the studio.
Whoa, hot mic, Dane.
Sorry.
Slow. Gee,
My bad.
You turn that guy down.
You're excited to be back.
I love it here. This is my favorite place to be.
World traveler, loves to be
extraordinaire
in a podcast studio in a bowling alley in Kaiser, Oregon. This is your favorite place to be.
You know, I see.
Mine
when
too.
you put it like that, it sounds weird.
The smell is comforting in here.
Yeah,
It's comforting.
it is.
Mm-hmm.
It is a little warm today. I won't lie.
We
to
all
you.
know that smell of the roller skate rink and the bowling alley.
Oh,
It's comforting.
that is true.
Olfactory.
Mm-hmm.
It triggers memories.
Why is it that every
childhood.
roller skate rink was designed the exact same way? Like if
What
you
do
see
you mean?
videos of people roller skating,
Where you go in a
it's
circle?
like Skate Palace.
Standard.
Standards.
Standard. Yeah.
Yeah.
No,
Yeah, where you go in a circle, but it's the breakout areas and the restrooms and then the bars and then the practice area
Should
and the
you
rental area.
Would you design it differently?
Well, I mean, if I were in the 80s, I'd do something the exact same way, too.
Put the bar in the middle and have them skate around it? Or
Well,
what?
there you go. That's what we need.
Now
This
we're
is how you
thinking.
modernize Skate Palace. You throw the bar in the middle and do the circles around it. It's like the swim-up pool bar, but it's a skate-up bar.
Hey, we got an idea now.
And I meant the practice area where they had bars you could hold on to, not an actual drinking bar, but I like where that brainstorm
So
went.
we should put the bar behind the bowling pins in the bowling alley, so you have to walk down the lane to get your drink when you're
Yeah.
bowling too.
This seems like shiny object.
Yeah. There's a guy in Wilsonville redesigned a golf course there. He put a bar in the middle, and it's got 6 or like 4 3-hole loops. So you play 3 holes, come back to the bar, play 3 holes, come back to the bar. And the greens, the sandboxes, and the tee boxes are all natural turf.
What's that mean?
It's just fake grass that never needs to be mowed.
Oh, but so it's not natural turf. It's
Correct.
just
AstroTurf?
Fake
AstroTurf.
AstroTurf.
Oh.
It's fake.
Okay.
Did I say natural turf?
Yeah, I was like, I think that's just grass.
It's grass-fed.
I'm not a
synthetics.
soil scientist or
Grass-fed
nothing,
synthetic turf.
but I'm pretty sure that's what we call grass.
My pineal gland isn't working today. I'm sorry.
All right. Well, we're doing this podcast for you guys because we love to hear ourselves talk. And we don't know what we're going to talk about, but we're just going to talk. So I have questions. No, we're going to do a little bit of a market update. We haven't done a market update for a while. I feel like we are going through a market shift. And I want to hear Mike's take.
Dude, what are you talking about? Our market's been the same for 3.5 freaking years. It's so boring.
No.
I feel like
There's nothing different right now than it was a year ago.
something's changing in the commercial world, at least in
Oh, for
multifamily.
sure.
So I'll tell you what.
Demand, it's the butt pucker. The money pucker has come to the ultimate height. Demand is contracted to the point where no one wants to buy.
It's a buyer's market.
Absolutely.
So in one way, I really like the buyer's market because now we're able to put deals together that for the last 3 years we've had a hard time getting sellers on board for the kind of deals we want to do. Sellers are more willing to lower their price. They're more willing to be creative. They're more willing to carry. Some sellers' notes are coming due. Some sellers are getting in trouble. Like, I feel like a few years ago, everybody was looking for blood in the water. I think the blood in the water is now. I think it begins now. I don't know where it ends. The problem with blood in the water is like we're also in this game, and so we're bleeding in places as well. So it's not just like, oh, all of my properties do fantastic and there's a few people out here in trouble, so I'm going to go buy their deals. It's like we're all in trouble together. Some are in more trouble than others. So you want to position yourself for times like this. This is what everybody's always taught me, is be ready for this moment.
This is the best time for a new investor to get into this market segment.
I agree.
Yep.
I don't think a new investor will get into this market cycle, though.
Well, that's one of the reasons why it's the best time to get in, because people are like pack animals. Like we all kind of go in the same
It's all
direction.
like it's more like a 90-10 rule than 80-20. Some people will, and they'll be the motivational speakers of the next decade.
The people who are meant to do it will still do it, but all the people who are on the fence are not doing it.
But that's nothing new.
Yeah, but
You think there's more
the reason
people on
there's
the fence?
the reasons there's deals not because of that. The reasons there's deals because the bigger buckets of capital are frozen, and that's where we come down to the Fed rates. I was on a call yesterday, and someone mentioned about the Fed rates, and it has nothing to do with interest rates. We've talked about this before. Lowering the rates is the fence, the wall to the money on the sidelines, and they have to keep it on the sidelines. So they won't lower rates because if they lower rates, money floods into the bond market and the stock market, so debt costs will go down, stock prices will go up because debt costs went down, money will flow into assets, asset values will go up, yields will go down. That is not the environment that we need as an from a global economy standpoint. So the Fed won't do that. Why we don't have deals is because the Fed is holding capital on the sidelines by not lowering rates. And so it creates opportunities for people that do want to buy.
So they've slowed money down.
Yep.
And people are starting to feel that now. It took a few years.
Extend and pretend. So what you're talking about is the byproduct of extend and pretend. So when you're pretending and extending, you don't have to do a deal. So buyers can't do deals. But extend and pretend has a wall at the end where you just won't go past that wall. And we're getting closer to that wall, which means now buying opportunities come up. Where my concern comes is, what happens when that wall, it's like a dam, what happens when that breaks? Because if we stop extending and pretending right at the same time that people are trying to buy, you have this mass need for money, but we're in a deleveraging scenario. So deleveraging scenario is a lack of liquidity when there's going to be a huge demand of liquidity. Does that make sense? Mm-hmm. So that's the concern I look at of like doing sub twos and land sale contracts and keeping debt in place is, if it's got shorter than a 5-year time, a year ago, 3-year time run seemed fine. Right now, I want a 5-year window of runtime.
And so this is interesting to point out because, Mike, you do more of a you look at a short term. You're doing more flipping. You're doing more positioning to now's the time to buy, now's the time to sell. And that can change a couple of times in a year, or even multiple times in 1 year. Whereas we're buying on more like 7 to 10 year timelines, and we're always just trying to get our name on stuff, sit on it, reposition it, and hang on to it for the long term. So we look at the world through a whole different lens usually than what you're looking through the world at. But what I'm interested to see is there's a few dynamics that we're watching. One of them is just occupancy. So from a multifamily standpoint, what we're seeing is that it's summer, so people are moving around, but we've had certain markets like Salem, Lebanon, and other areas that were a little more overbuilt than other markets in Oregon that have just been harder to rent units. We've had to bring the rents down a little. We've offered concessions. Stuff has sat out there like through the winter. There was stuff that didn't rent for a few months. Like it's just felt sort of weird, like we didn't have that before, and so it may not be necessarily super hard, but it's harder than it was. It feels hard because it was so easy before to get units rented and to find tenants. So now we're really having to focus on where are we advertising, what do our photos look like, are we showing those units correctly, have somebody gone out to make sure it doesn't stink, like we're talking about and thinking about things that we weren't thinking about before. But one of the things that I've noticed is that both Lebanon and Salem and other markets that aren't moving quite as fast as the markets that are really doing well, they're starting to lease up faster. So like Salem, just specifically just in the last couple weeks, we're starting to see an influx of people that are filling out applications, getting approved, executing contracts. And so I think from just an occupancy standpoint, we got people moving back into apartments again, where it feels like spring. We're in the middle of June, and it feels like spring just finally hit. Now, this might happen over a few weeks and go away. That's what I've sort of noticed over the last few years is the trends aren't really, they like start to become a trend and then they fizzle out. And so we've had these sort of false starts over and over and over. It's like, now's the time we're going to take off, and then a few weeks later we're back to where
finicky. I've been using the word finicky, and everyone keeps asking me, what's finicky? What is finicky? When is finicky? So I thought of this analogy that makes a lot of sense. When you water a yard, you can water it with a sprinkler, you can water it with a water hose, right? So if you're watering with a water hose, what do? You let the water go, you kink the hose, you move it around, you water it again. So think of demand as watering your yard. You can put a sprinkler on it and it just stays on, and you just have consistent demand that goes. And if you're delivering inventory and you have consistent flow of demand, you can have consistency in what you expect from that demand. But we're very finicky. We have a garden hose where demand's coming at a spurt and it turns off. And It comes at a spurt and it turns off. And so now timing becomes even more necessary because we don't have a consistent flow of demand. And so in the sales side, that some comes from sentiment of buyers. It has a lot to do with interest rates. It has to do with elections. It has to do with, are we going to a recession? Am I losing my job? On the rental side, it comes down to what are the demographics of your actual economy? What are the jobs? Are people moving? Are they not moving? Are they looking at, well, I'll just take a rent increase instead? And so it's not just the supply side of the equation, it's the demand side too. And so we have to understand, we've talked a lot about supply and just supply getting dropped in the mid-valley, and so you're experiencing oversupply, and now you have concessions and you have options because you're competing with sellers, but if, or leasers, other owners. But if you add in the demand side of the equation and understand that we just don't have a consistent volume of demand, now your competition against your other owners increases during those periods of time, right? So demand's there, less competition on the owner side. Demand cuts off, it's stopped, more competition on the owner side. Mm-hmm. And so that's where, if you understand and you can see these little cycles, you're like, oh, we can remove concessions now for this because we have a flow of demand. Oh, we need to double up or triple up concessions right now because there's no flow. Or you ride it out and just hope that it comes in, but then you're just taking on longer vacancy for a period of time. And so like we were seeing this with our staff where, dude, it was weird. February and March were pretty darn good, and then April, like demand on everything got cut off in April. It's like, dude, we have to offer concessions. We have to get these things leased, because if we don't do it now, then our income is going to be just down for the year. Where on the selling side, I'm not doing any price reductions right now. Why would I do a price reduction when there's no demand? I don't want to look weak into a non-existent market. I'd rather look high, so someone thinks they're lowballing me when I know that the market just isn't what I'm asking, but I'm purposely not lowering my price because I don't want to show blood on the water. I'd rather take a lowball offer and a huge price reduction than bleed down to that price point. Does that make sense?
So, yeah, it does. So my question for Mike, and then the follow-up question for Dane and Trevor, I want to know where your guys' heads are at in the next 3 to 6 months. Where do you see the housing market going in terms of values and transaction volume, interest rates, and so on? And then to Trevor and Dane, similarly, how do you see the multifamily and commercial markets behaving in that same time frame?
I have no clue, because I have no clue what the president's going to do. And our debt costs are fully baked on what the president's doing.
So you feel
right now.
locally the residential market could go either direction based on policy?
Yeah, and the reason being is because we're on such a fine line of interest rates getting to a point where we can move forward to being at a point where we're just cut off.
What's the interest rate we need to move forward?
Like 7% cuts us off, 6.5% moves us forward, 6.25 gets us flowing, 6% makes it a good market, seller's market.
Okay, and where are we today?
We're like, we just came under 7. We like 6.85 today was the report I saw. So if you think spreads are going to be 2.5, we need to have the 10-year under 4.5. We have barely gone under 4.5. When we do, we should, like yesterday we were 4.35. We started the day at 4.35. We're at 4.45 now. The only reason we got down to 4.35 is because the past couple of days we had soft inflation reports. But Israel just started bombing Iran, and our 10-year yield went up.
Well, yeah, because gas price is going to go up, right?
That's inflationary, correct. But typically in wartime, we have a flee to safety. So what we've been shown over the past 3 years, the flee to safety no longer exists. So
normally you would expect that to drop.
Exactly. We'd expect the 10-year to go down because world chaos, we're scared, we need safety. We're going to go buy American debt because that is the safe asset class. So if people are not fleeing to safety when they should be, or when they are fleeing to safety and they're not choosing our debt, that tells us what the world thinks of our debt. So now apply that to mortgage rates. How do we get the 10-year yield to cap out at 4.25? Right now it's capping out at like 4.5. It was capping out at 5. If spreads are going to be 2.5, we need it to cap out at 4.25. So rates are 6.75, and we can have a flowing market.
I thought historic spreads, risk spreads, were like 1.6 on average.
Yeah, and so that goes to the Fed. The Fed's been supporting our mortgage market for 2 decades
and now they're not.
And even reverse, they have to make a decision. Do we support the mortgage market or do we support American debt? Because they own both. The Fed balance sheet is just debt. They just own debt. They own American government debt and they own mortgage debt. So they're running off their balance sheet $35 billion a month. They're only letting $5 billion of that run off of the American debt side of their balance sheet.
The rest is mortgage.
Yeah. So think of it this way. The American debt part of their balance sheet is significantly larger than their mortgage side. So they're letting 6 times run off the smaller balance sheet than they are the larger balance sheet. So from a percentage standpoint, that tells you their decision. Their decision is, we're not supporting the mortgage market. We have to make a decision of the two because we have to reduce our balance sheet. So we're choosing to support the American debt market. So where would our 10-year yield be if they were fully running off their balance sheet and they were not buying any more debt? Who's buying it, and then where do yields go to? And so when I look at the Fed, keeping the 10-year no higher than 4.5 is status quo. They can't let it get worse than that. They don't need it to get better than that in their mind and in their view. And since they're letting mortgages run off their balance sheet, our spreads are going to be high. So we just need to be acceptant of a 2.5 spread. Even though historic is a point less, we need to expect spreads to be 2.5. So we need the yield, the 10-year yield at 4.25. So we have a 6.75 rate. So we can be below 7. So we can have transaction volume somewhat above historic lows.
So your feeling is the risk spreads, the 2.5 points of risk spread, is because of the Fed not propping up the mortgage market. So you feel that that spread will remain higher than the historical average.
That, and combined with just its debt and concerns of inflation.
Now in commercial, it's different. The commercial spreads are like 1.5 to 2. It's a different risk spread. And we're seeing rates now in the sub 6 range, and we've seen some quotes below 6. But most of the time on smaller stuff, we're still closing in the mid to high 6s.
Mm-hmm. Well, and I'd say, because they look at an annualized risk-adjusted rate of return, inflation-adjusted rate of return. So commercial notes have lower cycles. I imagine they get paid off lower so they can get lower yields because it's a shorter period of time. They don't need to have as much because they're not making.
Yeah, it's a shorter time window. You're not looking at the 30-year bond. You're looking at the 3, 5,
right.
7,
So
10.
like if a residential mortgage gets paid off in 7 years, they need to have a 2.5% spread to earn what they need to make over that 7 years. But if the commercial gets paid off in 5, they need to have a spread that shows payoff in 5 instead of 7.
So I want to pivot to Trevor and Dane telling me about what they think on the commercial side, but I'll just tell you from my own personal perspective. Like right now in my whole real estate career, I believe is the best buying opportunity I've ever seen. And I think that we are in the process of buying more assets than we ever have before, which is terrific. Where my mind is at is I've been doing this now for a while, and 10 plus years I've always rolled all of my gains into 1031s. I've rolled it into future growth. So I've never really had a big hit moment, like Paul calls it, a hit. Your ship comes in where you go like, okay, we're going to sell one, we're going to refi one, we're going to put millions of dollars in our pocket and then reset and go. And I've ridden pretty close to the line and put everything into growing the portfolio. So I'm going to turn 50 this year, and I'm starting to shift my focus. I want to be a little more conservative. I want to carry a little more liquidity, and I feel like it's going to help us in the long term to grow the way we want to in a sustainable way. And so now I'm looking, for the first time in my life, I'm looking for a hit. I want one of these ships to come in. I'm going to manifest it right now on air. And okay, fine. That's cool. You can talk about that. But literally, at this moment, what I should be focused on is, for the last 12 or 13 years, I've wanted this moment to come, and it's here, and I'm not super grateful for it because
your cycle in life.
Now where I'm at in life, I'm going like, I want more cash, and I typically have not been like that. So Trevor, you tell me where you think we're at in the cycle and what's going to happen.
I think, to your point on more cash helps you be more aggressive, think with a clearer mind, and you can grow faster rather than how you guys have bought deals in the past a little bit. So I think yes.
We're flying by the seat of our pants, right? Like, I mean, we're always we're reactionary instead of being proactive.
Yeah, I think you guys had a really good model, but I think if you shift it slightly, you get to buy more deals, and it really helps you. And I think that's what we're doing.
I don't know, being hungry for deals, like having cash doesn't change any of that.
No,
right?
it's reserve. So I think 3% reserve on property value is a really good number to keep as a base level. Just a general rule of thumb. It's different per property, but I think if you're doing that, you're pretty set.
But what's the benefit of that other than just lack of stress when you have big capex come in?
Yeah, so that's the benefit.
That is the benefit of it. But it doesn't solve anything what Gabe just talked about.
Yeah, I don't necessarily want to raise capital so that I can go put it in future deals. I just want to have enough in reserves to where when we do have to feed a project or...
Yeah, you're not having to pull it from that other project
so
that you didn't want to at that time.
Like I heard you say a big hit. I frame that as a personal hit.
Yeah,
you're not wanting a personal
dollars.
hit.
Yeah, when I say hit is a good thing.
I understand that.
I'm looking...
But he's talking about... He's answering the question from his own best self-interest, which is if you fund our reserves, we have more liquidity, we can get more loans, we can buy more real estate. That's not what you're talking about. You want a big hit so you can...
You want to go buy some stuff.
It'd be nice to have the reserves in place for the properties and the companies, but also to have a personal reserve just so to me, just so it's like a little bit easier to sleep at night. Mm-hmm. I think that's kind of the takeaway is like there are things, you know what I'm saying?
Get over it, dude. You don't need to sleep well.
I actually do sleep fine. I'm sleeping fine. But
so you're doing the right thing then.
Well, I don't know. Maybe I just learned how to sleep. But I mean, I guess my instinct says for me anyway that I'm riding a little too close to the edge. I'm not like Paul Curley's 75 years old. He goes way beyond the edge.
It's because he has one deal.
I would ask you this: are you projecting what Paul's going through right now into your future self?
I'm not going to do that.
Okay.
Yeah, I've decided I'm not going to be the next Paul Curley. That'll be Trevor.
That's what I mean. Like you're making decisions based on what you've seen Paul go through.
Yeah, I'm not going to do it.
That's learning.
Yeah.
Yeah. No, it's good. But
Paul has the sickest. Like Paul his investment model works and it's awesome. But I think if you tweak it a little bit, you get to do more.
Well,
but stop thinking about more. Start thinking about what Gabe is. So, like, where I'm thinking of is making this decision to slow down at 50 better than doing it at 53? Should you take this last 3-year run window to just build your foundation out to a level that then you make these changes you're talking about?
I've said this before that I think that backing off the gas pedal a little bit is actually going to help me grow exponentially.
You're not going to slow down. You're about to do the most deals you've ever done over the next period, 2-year period.
Yeah, I know that. Yeah, I do. But I also want to be in a position where, I mean, every single day, guys, I get phone calls and emails every day that this one needs money, that one needs money.
That's why we're solving that problem right now.
Like, I guess I've always been so focused on I need the assets that I haven't really been focused on the cash.
Well, because you're not focused on necessarily property performance, and there's a lot of spread there on your size of portfolio now that you can capitalize on. And then that doesn't only pay off through cash flows, but through the cash out refinances and everything else. I mean, $100 rent raise on one property, $20,000 on one unit, and you have thousands of units.
Well, a little over 1,000.
You have millions of units.
One day we'll have thousands.
So how does what you're talking about solve the problem that he's talking about? So, like, explain it for the audience of a big hit of liquidity, but keeping it in the business.
And really what I'm asking is, like, in times where it's really advantageous for us as a buyer to be able to go transact in this market is also the same period of time where money moves really slow, and it's very hard to borrow money, it's very hard to raise money, and so our cash position gets weaker and weaker and weaker as the market that we want to buy in gets better and better and better, because it's counterintuitive.
The
right?
reason
the
that
reason
it gets better
why,
is because everybody else's cash position
everybody else is
too.
just like us.
Yeah.
Is this not the best market you've seen based on a rent to price ratio? Because this seems crazy to me, because everyone says Midwest 1% rural, 1% rural, and in Oregon we have the 1%.
Everything we're buying right now.
How many times have you heard me say real estate's on sale?
Yeah. You've never seen this in a decade.
So that's like, to me, I'm like, this seems like a no-brainer. These deals pencil on today's rates a lot of the time.
And we get to be in our own market, in an appreciation market, and cash flow.
Yes, and I just think it's because prices have stayed flat and rents have increased over those 2 years, and that we're going to see the disbalance of rents aren't going to. So, like, when I underwrite right now, I'm assuming no rent increases for the next 2 years because we had such aggressive, depending on, I mean, from market rate, not just on where they're at.
Well, Paul always says you got to grow out of your problem, and so I don't necessarily have a problem. I just feel like I could have a problem. I'm trying to preemptively be conservative and set ourselves up. So I know we got hits and stuff coming. We actually have lenders that will lend to us. We have investors who invest with us. We're doing really, really good in this market. I don't know that everybody is. I think that we're doing a really good job in a market where it's hard for a lot of people to buy.
I think it's a combination of that, and then we're being taken more seriously. You are taken seriously, but we weren't really taken seriously.
Oh, street cred.
Yeah, just because, like, we're like telling people we're buying these deals, and they're like, no, you're not. Like, But now it's like, no, like you are seeing the deals, like you're seeing this come out of this $18 million.
You're on the CoStar radar.
Yeah, come out of the ground, or you're like
getting the CoStar calls. Yeah,
because
it sounds like we're in the same spot, which is you want less reactivity in your business.
I want proactivity.
You want proactivity. And like I just sent a text to my project manager. I'm like, do you want the real answer? He's like, I don't know, maybe. And my answer was, I want to stop reacting. I want to stop this process of reacting. But you need the right team members in order. So it's nothing about buying. It's nothing about liquidity. It's about, do I have the right team members that can help me stop being reactive in my business?
And maybe I'm just seeking comfort. I've always said that your whole brain doesn't really light up until your ass is on fire.
Yeah.
But I think that what I also feel like is if we got ourselves in a position where we weren't always, every time we turn around, trying to solve a problem, that we could be a little bit more like, we came up with the idea that we're going to go do this or do that, right? Rather than like every single moment of every day, we're just like, put this fire out, put that fire out, put this fire out.
You can make better decisions, yes.
Yeah, I think so. Maybe clearer decisions. For me, if it gets too comfortable, I'm going to get lackadaisical, and then you guys will be like, Gabe, stop playing video games and come back and do deals.
It's a brain fatigue factor, too. When you're having to react, you can't make quality decisions because your brain's worn out.
But sometimes you make better decisions when you're just...
Sometimes you work harder. I don't ever make them better decisions, but you work harder.
You're more engaged,
Yeah.
I would say.
No, because when I was out of money, I made really bad decisions, and I just sat on them because I didn't know what to do. Had I not had that, I think you make clear decisions. So I think as you're buying deals aggressively, but you have the cash reserve, that is the best spot to be in, because you can say no to so many more things or negotiate them a little harder.
But then I've seen investors that, they're sitting on $30 million cash, and they're going, I got to get off this cash, and 10 years later they still won't buy a deal.
That problem.
Yeah, because they're just like, oh, I got to rip something. Maybe today they can actually go find something after 10 years, but they think of the opportunity cost of sitting on $30 million cash for 10 years and not putting it in a deal.
Yeah.
Like, I mean,
who does that? No one does that.
I think I know the guy you're talking about.
I don't even know if that's real. If it really
it's not. The guy I'm thinking of isn't at 30, but he's in the tens of millions.
Well, and if you have a big enough portfolio, having 10 or 20 million on the sidelines is not a bad plan.
I think it's important to note too, like, you've never been anywhere near the position that you're in right now, where during COVID, money was flowing so freely and your portfolio grew so much that you've never been in a position where you actually had to think about what was going on with your liquidity. Because it's like, if you have the same liquidity right now that you had 6 years ago, you're in trouble, right? I mean, you're not actually in trouble, but the way that your mind should think about it is like, I'm going to be in trouble, or I could be, because your portfolio has increased so much. And so the same dollar amount, that your zero is just way higher than it used to be.
Yeah.
And so your zero needs to continue rising. And I think that you backed off of brokerage, and brokerage hasn't gone as well. And then you doubled down on property management, but property management is like fixed income. Yeah. And so now you're relying on property management and then a big hit from a property.
Sounds like you need to figure out how to make some more money, man.
Well, it's a big hit from a property, which you can do, and it doesn't have to be from brokerage anymore, but you're privy to the fact that like your next big hit isn't going to be a big brokerage paycheck.
Yes, and so the ways you were doing deals on the front end was over a 10-year time frame, which is going to make you a bunch of money, but over such a long period, versus how we're doing deals now is a quicker cycle on some of them.
Yeah, so where do you guys see in the next 6 months that this goes? Like, what do you think? Is this buying window going to be open for a long time? Is money going to flow again? Where are the hits going to come from?
I think we'll adapt to any market cycle that we're in and always be able to buy deals, because we have so many ways we can buy deals. So I'm not worried about it, but I think we should be trying to buy as many possible deals right now.
Don't we always do that, though?
Yeah, but I think but
why?
We didn't over the last couple of years because we weren't focused enough on it. Like, we were doing deals, but we weren't focused on doing deals. If we were focused on doing deals, we will do way more deals. Why what? Why should we buy more deals right now?
Because
sellers are desperate.
You can find better deals. You can find more leverage. You can find cash flowing deals.
I mean, the other side of it is like, brokerage has been so bad for 3 years that we have brokers that the moment we talk to them and we're like, hey, we would do any deal on these 3 structures. And if you have anybody who would do a deal like this, used to when we said that, it was like 1 out of 5 brokers would have 1 deal. And if it's now 3 out of 5, you're doing 3 times more deals, and the hit rate on those deals is so much higher because the sellers are actually ready for it.
So, and just to be a devil's advocate,
Please.
a lot of things that you've been saying sounds like a fucking bubble.
Yeah.
And do you want to be buying on the front end of a bubble?
It's almost the opposite, though. It's like the opposite of the bubble. I feel kind of almost like the bubble has popped.
Yeah, I think we're buying at the I know we're buying at the discount.
No.
Yeah.
Maybe
So,
not in
and-
residential. I think
Yeah.
residential prices are going to come down. That's my...
I disagree with that wholeheartedly. And the reason I bring this is you're talking about sellers are desperate. Distress is out there.
Yeah.
Distress has been held back. Distress is getting released into the market. We haven't had transaction volume. We don't know what properties are worth. We have no clue what properties are worth because we don't have the transaction volume on the other side. Rent to price ratio is the best it's ever been. Is that going to get better or worse?
Worse.
Okay. So
this
are we
is
in
the
a bubble?
bottom.
But I
This
don't
is the
care.
bottom.
Is this the beginning of the bottom?
I think...
Even if it is, I mean, you can never hit it, though.
I think
It's
And
a
the reason
moving
I'm just being a
target.
devil's advocate is because this doesn't matter as long as you buy on a 5 to 7
Well,
year
that's what
window.
I was going to
We're
say.
buying
Buying on
Ideally a 7 to 10 year window.
10-year debt.
Yeah.
So,
Yeah.
So I try, like my whole thesis is you avoid that completely with long term, and we do take short debt. So like we are doing deals where you have to do it. Like it's short debt. That's
Yep.
the only way the deal works. Like we are going,
Which is the riskiest part of the, and that's,
is,
and
but
I've
that's-
slowed down in some of the stuff. So why are you taking on short term debt, and why? What are the projects you're doing that for? Why do you feel comfortable?
We can create such a big spread
Of value
Yeah.
creation?
of value.
Yeah.
So
creation.
value
even
add.
if values go down, it
So
doesn't matter.
bridge debt on value add assets in the short term time frame
You
are
gotta do
okay.
it. You got to do it.
Yeah.
But if we are in the beginning of a bubble or at the front end of the downside of the market, what are you refinancing into, and how do you bake that into your plan?
Yeah.
I'm not worried about that because a lot of our stuff is repriced and rents have increased, and you just need to refinance your current loan on 5 years ago price, and I'm okay with that.
Wait. You want to refinance
So-
based on 5 years
so-
ago price, but today's price is less than 5 years ago
No,
price.
because it's based on debt cover. So if rates aren't going, even if rates are higher and we were taking debt at 4.5,
You mean loan basis? Loan basis. Yeah. So you're
I'm not
taking
concerned.
out 5 year past loan basis at new rates with higher income to offset the change in rate.
Yeah.
So you can still take that loan principal
Yeah.
out. So are you talking like 55% leverage? Like what's your leverage rate to feel
At
good?
that point?
No, yeah. So you feel like you can
Dude.
take it out.
I mean, we're buying a deal right now that we're going to get a 75% loan on and debt cover on still.
Which has not happened in 4 years for everybody listening. 3 years since early 22.
Sure, but and then how long is that debt?
10 years is what we're going to place.
Well,
But it'll
okay,
probably-
yeah,
it'll
but
probably
we're
be a
talking about two
5-year
different
reprice.
things. We're talking about two different things. I'm talking about your bridge debt. How short of a time frame is your bridge debt?
So we were doing construction to perm on a lot, so we're getting 5 year, but we're taking on, well, shoot, we don't even have any short debt. But I would
Yeah, we
take
do.
short debt on
Yeah,
some-
dude, like it's all
have-
freaking relative. Like I don't take on loans more than 12 months long.
we have a
Short is different for us.
Short is relative. Yeah.
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 No, and one of our loans is we have an 18-month loan out right now.
Yeah.
But on that, our loan to value, loan to cost was relatively high, but loan to value
Low.
is 54%.
That's what I'm getting
And
at.
so it's like,
if
even
you're going
if
to take
we-
on 1 to 3 year debt, you
Yeah.
need to have a very low leverage point.
Yeah.
And so like saying is my guiding line on being conservative. If saying gets really conservative, I really think maybe I should think conservative. And so that's kind of where I'm only taking on 1 to 3 year debt on the projects where I have a seller in second and I have such a low LTV, or I have so much value add that I have such a low LTV and I have such a DSCR debt coverage ratio that there's no doubt in taking that land out. But I don't want to expose myself to the commercial market in the next 24 to 36 months. I do not want my fucking bathing suit to go down in the waves.
Yeah, let's assume it is 2008, right?
That makes sense. That's a
I'd love that.
slaughter to Warren Buffett
Bad-
quote.
bad visual.
So let's assume it is 2008 and we're at the peak and it is going to go down over the next 2 years.
Yeah.
I think looking backwards, I would still try to buy as many deals as I possibly could all the way through.
Well, that's a great
cycle.
analogy. So 2008, if you took on 5 to 7 year debt, the 5 year may be a little skeptical. 7 years fine.
Yeah.
And so that's where you just understand the cycles.
And at that point, you have such an advantage because you are the buyer in the market all the way through that,
Yeah.
where you're acquiring so many more deals because now we get to do more deals because no one else is buying and everyone is scared to buy.
That's what I was going to say.
And even if the market's going down, it's a version of dollar cost averaging into this
Yes.
asset class.
Yes,
Yeah.
and you can still, as long as your rents support it on a longer term debt, I don't care, because the price matters when you buy, sell, refinance. If you're
And
not
that's
doing
the
any
whole
of those,
key
it
is
doesn't
the
matter.
sustainability of your debt. And I'm just so glad to hear you guys talk about
Well, I
this.
want 10-year debt on every project, just because if you look backwards at all the market cycles, you can make it through a 10-year period,
Yeah.
and you're going to pay down around 20% of your loan. So if you don't go up by $1 in value and you have an amortized loan,
And in order to do that, you're taking on 10-year debt with a 5-year reprice and probably a 5-year prepay, right?
a lot of it's 3-2-1 prepay.
3-2-1 prepay.
But some of them are longer. Dude,
The
there
other
was one
beautiful
loan they
thing
got-
about this market is prepays really don't matter. Like, this is how I think about prepays is if you're even in a 5-year prepay, if you're at a point where you're just going to go, there's opportunity that's worth way more than a prepay. And so
Yeah.
if you need to do that just to lock in your
if you have
10-year
a
term.
1% prepay on it, it's kind of like,
Yeah,
at that
exactly.
point, it's
So we
okay.
pay a little interest vig in order to take care of take advantage of the other opportunity.
Yes.
Yeah.
So we think potentially we're at the beginning or the end of a bottom on commercial.
I don't think about that.
So
But that's not good for our audience.
but because no one ever gets it right. So why do I think I'm going to get this right and make decisions
So-
on this thing that may or may not
so you're
happen?
not timing markets.
No, well,
not
I think we are timing markets, and that's why we're buying so aggressively right now.
Well, we're
If
buying
you-
because we can.
No,
If
you're
you
just buying. You're understanding the cycle that you're in and setting up your debt according to the cycle that you're in.
Well, yeah, we're buying.
I think
We
I'm doing-
know the timing. We're timing the market based on the cycle that we're in. And so you look at the best year for the market after 2008, and the best year for the market was 2014, 2013 in terms
In
of
there,
total
yep.
recovery. It was those years. The best year for Berkshire Hathaway, the best year for Blackstone were 2010, 2011, 2009 through 2011. And so they knew, hey, we're not going to catch the bottom. Everybody's terrified right now, but I know that I'm buying at a discount. And so the market itself might have had way better returns in 2013, 2014, but everybody was trying to buy. And so if you look at individuals in that time, it's like I could only spend $1 million. I couldn't even spend all the money I wanted to because everybody was buying. But then you look at 2009, 2010 for Berkshire, and Berkshire was like, shoot, we had 70 billion in cash. We put it out there. It's all gone now. We spent all the money because we finally had a chance to just spend all our money at a discount. Yeah, it went down still in 2011. We lost a little money, quote unquote, on paper in 2012. But then the 70 billion that they put out in 2010 turned into 250 billion from 2010 to 2016. And so because they had the opportunity to buy all of that, and I think that's where we're at right now, is that if we bought right now and we said, I need to sell in a year, it's like, I don't want to do that. Because I don't think we're at the bottom yet, because I don't think we can time it.
I would be
You're
scared to
not
do that in
timing
any
the market.
cycle.
You're setting your cycle up given where it's at. Because you're by timing the market, meaning you're not buying and selling.
No.
So you're just being smart in your acquisition cycle based
Yeah.
on where you think we are in the general cycle, which is really
Yeah.
easy to map out when you think of long enough time.
But I
frames.
think we do that in any market cycle, because the whole point is I don't think you can predict a market cycle.
no.
And that's not what he's saying. The idea is that 2 years from now, it's like, hey, we're still buying all the deals that we can. But the we can is the important part, because it's like, yeah, in
Yes.
2021, we wanted to buy everything. But right now, it's like we're buying all the deals, and we can buy all the deals.
The other part is we're buying on margin. So if you're not setting your margin up correctly, the stock analogy is they released all their cash. We're not cash investors. We buy on margin. So you just need to make sure your margin, your debt, outlasts the cycle.
Sorry, I'm
But
pretty
to
loud.
answer your question,
you're yelling at my
are we
I
in
got
the
so
are we at the
excited.
bottom? Or are we at the beginning of the bottom?
I think the
I don't
answer is
know.
different for commercial and residential.
Yeah.
I don't think
But-
you can answer it.
Tell me why you don't think residential is going to go down in value. I feel like we've got all this inventory that's locked up, and eventually rates are going to come down, and it's going to unleash a lot of that inventory at once. I think there's going to be at least a blip of, you think as soon as those rates go down, everybody can qualify for a loan, and now all that pinned up
The
demand
increase in demand will more than offset the increase in supply.
Okay.
Demand just moves faster.
But
than
right
supply.
now, I've seen a little correction in housing. Like, we're not able to...
Dude, I've been saying it for fucking ever, and finally we had Zillow say that prices went down
How much?
0.4%.
I think the market's down
Wow.
closer to 10%.
Dude, it comes down to the market segment. Existing homes in good neighborhoods are not going down; they are going
Isn't
up.
that always the case, though?
No.
Isn't there
No.
always
No.
going to be that piece
That
of
has
real
not
estate?
been the case from 2012 to 2022. There's a 10-year period of time where it didn't matter your location. It was really it was the 3-year window at the back end where location didn't matter because monetary policy just said just buy
everything.
doesn't matter where it's at, and now we're getting back to locational.
Location.
But inventory can be scooped up over that. So all we do is we look at supply levels. Well, supply levels are based off of historically low demand in a 1 month period of time. You can't project out 1 month. And here's how you need to understand so purchase applications. You need to understand leading indicators. This year we've had 22 prints. 11 of them have been up. 8 of them have been flat, or 3 flat, 8 down, or whatever it is.
What are you saying? 22 prints?
Weekly prints of purchase applications. So this is every week the people getting into the purchase market, right? This is the best indicator of leading demand. Yes. 3 of those 8 negative prints were in the month of April. And so when we look at supply levels that come out in May, that's based off of not just historically low demand, but demand lower than historically low demand multiplied into the amount of houses. Yes, we have more houses on the market right now that we can buy than we've seen in a while.
Long time, yeah.
But the ratio of 3 months of supply is less to do with the number of the 7,000 units on the market, and it has to do with how low purchase applications went, pending sales went, and closed sales went. And so to answer your question, we don't know because we don't know what the 90-day pause looks like. We don't know what the long-term tariff issue looks like. We don't know how much more debt we're going to issue. We don't know what the spending bills are going to look like. We don't know if we're going to go into war. We don't know if we're going into civil war. Like, there's so many unknowns that we don't know when sentiment's going to change. But when sentiment does change, the 3 negative prints in April become 4 positive prints in either July or August or September, whatever month it happens. And then when that demand flips, inventory goes from 3 months to 2.5, not because levels went down, but because the number of people participating in the buy side have increased. So it's a participation rate is really what we're measuring. And right now our participation rate is ridiculously low, which can change overnight. But when interest rates are hovering around 7%, it won't change.
What's our day supply right now in houses?
Dude, it's gone down like we're on a downward trend. It started at 80, we're down at 40 in the Portland area. And part of that is because when we started the
40 days?
40 days of marketing time. But why is it that some stuff is a lot longer than that and some of it's an average, right?
So I read nationally we've got a 5-month supply of houses. Is that true?
In Portland we have 3.
3, okay.
Yeah.
So Portland's lower inventory than nationwide.
Any coastal market will be, correct.
And so, 3 months is still a tight market. Really, there's just not a lot of demand or supply.
Yeah, I mean, we're hovering between a seller's and buyer's market, and we go in and out of those two things. We've been going in and out at steeper paces.
So you're saying the residential market is a little more balanced. It's not really. It's a little more of
it turns on a lot faster.
But in commercial, we're very much saying it's a buyer's market.
Yeah, and the commercial world is again going to the business world, and we don't know what's happening in the business world, where the residential world is just that demand is more of a sprinkler system than it is the hose compared to the commercial world, where it's way more hose and less sprinkler system.
So we're starting to see, at least for us, our transaction volumes going up. What do you see in the broader market, commercial and residential? Do you think their transaction volume picks up later this year? Is it next year? Like, when do we get back to a market that's actually transacting?
Yeah, I mean, historically on the residential side, it's March to May. That like last week in February, first week of March to the first week of May is our push of demand. Well, we lost half of that this year.
Because of Liberation Day?
Because of Liberation Day killed off demand in April, and that demand hasn't come back because interest rates have hovered.
Is that the same reason you think we're feeling that spring has just started in the rental market?
Exactly. Because now it's people get scared, they contract. So when people contract, they don't move, they don't make big decisions. They put their ostrich hat on, they put their head in the ground, and they just live. And then, things are feeling better. Let's look at changing our environment. Let's think about moving again. And so it's just sentiment driven, and interest rates never used to drive sentiment the way it does now. We're such a teetering standpoint on affordability. And the reason I bring this up, you look at affordability levels going back, we're at 120, 125%. You could have movement in interest rates and not affect the affordability of real estate. Right now, you have small movements really affect the affordability of real estate. So sentiment is so tightly tied to interest rates that it really, really matters. But it also isn't the only thing that matters. Because people are concerned about, well, where do I want to live? Is this the community I want to live in based on the civil unrest? Like, there's so many things that are affecting the mindset, No one can act like they know right now. I'll say this. I'm buying projects and I'm getting short-term debt, but I'm not buying any more. Like, I'm pretty happy with what I've got right now. I want to get through my pipeline. I want to see where we're at.
Tell us why.
Because new construction is going down. Like, because think of a competition. If you're an existing homeowner, you're competing with the other existing homeowners. You have limited competition that you're competing against. They all live in their homes. They're not considered a commodity. In the new construction world, you're all competing for the buyers that come on and they go off, and you're giving concessions and you're just trying to get rid of inventory. So the new construction is a better example of the overall market. The only reason I say values aren't going down is because the existing market is kind of stuck from a price standpoint, and people will just choose not to sell. That's not the case in new construction. On the flipping side, who do I compete with?
New construction.
Right. So I'm trying to get the prices that the price points in new construction are offer. I do have the protection of being an existing home in a neighborhood and not having a bunch of inventory around me, but I'm bringing inventory to the market. And if demand is fickle and finicky, I don't want to be offering a lot of supply to that market. And so I want longer term debt cycles, which means I'm not doing for sale projects, or I want to limit the amount of for sale projects I have. Yeah.
I don't understand flipping still. I don't get why you would do it.
Well, because most people don't have the ability. Think of it this way. A burr is getting your cash back.
Yeah.
It is very hard to burr.
Yeah.
So how do you get an equity bump if you can barely get your cash back out?
So I guess I've been talking to a lot of flippers and builders recently, and I asked them, like, how much equity do you create? And a lot of them will say like 30 to 35% equity in these things.
Because they're dumb.
Okay.
Because people run off small margins. The only reason our condo company didn't go under is because we didn't go off small margins.
No, 30 to 35% equity they create. Like, that's large.
Yeah, it's a 20 net ROI. It's a 15 to 20 net ROI when you factor in all their costs. It's not large. I thought you were thinking 30 to 40K gross money, because that's more realistic.
Equity.
Yeah, but per unit, it's 30 to 40 grand per unit. It's not a lot of overhead if you don't do it correctly.
I'm saying, like, if you're doing a project worth $1 million, they're all in at 700 to 750.
Yeah, until you think of that's gross margin. Finance costs, holding costs, utilities, closing costs. Dude, I'm telling you, don't fucking trust a builder. Just don't trust a builder. Like, if there's one thing you learned from me, look at their net sheet, look at their P&L.
Yeah.
It doesn't matter if they create 35% of profit. When do they pay their interest off?
Yeah.
When do they pay their closing costs?
I understand
Most of their fees are in the back end.
But I just keep talking to these guys, and they're wondering how to hold rentals. But to me, it seems like you're already creating the inventory that you can just hold.
No, because they're creating 30% margin in markets on the West Coast where you need to have 60% LTV to hold on to it.
But even if they leave some money in and then you cost seg those, I'm like, you can hold some of these and then accelerate
smoke and mirrors valuation, dude.
But no, just say the tax savings alone. If these dudes are making $1 million plus.
No, you do not justify acquisitions based on tax savings. That is error number one. If you have a pipeline and you can consistently close and you can actually use those tax benefits and you can understand asset management and you can understand that depreciation is real and you have to sell assets and you have to improve assets, yes, invest based on tax savings. But that is not a reason to go invest in something that you're not really competent in. If you have to use smoke and mirrors math to show a good investment, you are not competent in that investment.
No, I disagree, because I'm saying if they're doing flips, if they do 20 flips on the year and you can keep 5 of them, I think you can make the same.
That's a decision. That's a global business decision, not a vacuum of the flips. I'm telling you, a flip, every burr is an excellent flip. Very few flips make a burr.
Yeah.
And if your goal is to not sell anything, you need to do more than burr. You need to be able to pull money out of that burr. That is very difficult to do.
Yeah.
You can do 20 flips and hold 5. Sure.
Yeah.
That's a scale thing. That is a business model decision. That is not a market thing. That is not an opportunity thing. That is running your business in this way to meet this goal.
Yeah, my point is, like, the dudes that are doing that 20 to 40 or whatever, and they're keeping none because they want the now money. I think they can have the same amount of now money by keeping those and cost sagging them.
You know, someone just said to me, you can't expect an unreasonable person to be reasonable. It is their mindset, is their mind frame. That's the decision
they're trying to make an income. They're entrepreneurs.
But I think you make the same income.
I don't believe. I mean, I never called flippers an investor because I just don't think that's
They're
investing.
not. Yeah, they're business owners.
Flipping is just I own a car lot. It's the same thing. Like it's just a way to make money. It's a job.
Yeah,
there's nothing wrong with it. And every once in a while, you could translate those skills of flipping. And I've seen people do this where they're like, "Hey, we know how to flip a few houses. Why not go pick up a 10-plex and we'll kick everybody out and we'll clean that place up. We'll rent it. We'll hold that one."
Well, I think
Trevor, what's that complex that you're cost segging right now?
What?
You're cost segging one of your apartments, right?
No.
Okay, yeah, that's why the flippers don't do it.
What do you mean?
Because you're buying way more real estate and cost seg's really hard. Like their job isn't doing complex. Job, well, yeah, but why don't you do that then?
I'm cost
because it's something that they don't want to think about. It's something they don't want. You're still going to pay taxes.
It's a mindset.
When
thing.
you're already,
it's just not what you want to think about.
When you're swimming in depreciation, you got to have a lot of income to cover up. Like I mean, there's no reason to cost.
No, but these dudes have super high income. They want to know how to keep rentals, and they're all like, "We should go into the multifamily space." I'm like, "You already have this whole. You can build a whole chessboard on the exact thing you're doing now. I think you can make the same exact amount of money you're making, while keeping 20% of your.
You just need to show them a different finance strategy. That's just they don't understand the finance side around it.
Short-term hard money debt. And they may not qualify for the perm debt.
That's the other part of it is they just need to see how do I structure this subdivision in a way that I can so they're really good at creating inventory. They just don't know how to keep it. Yeah. Keeping it is a finance
It's a whole
structure.
different game.
And some people don't want to keep it.
But they
don't want the headache.
They're thinking, if I make enough money flipping, then I'll trade this into multifamily. I'm like, you can just keep your best 5. You'll pay the same amount in tax and keep 20% of your inventory, and then you can trade it.
That's the biggest mistake I see people make is they go, I've got to go make money doing something so I can get into real estate, when you can actually make the money in real estate. They could do the same thing that they're doing with houses with multifamily or bigger projects or whatever they want to do.
I'm just thinking if you keep 5 a year for the next 5 years.
I mean, you take the same hard money lender that likes you, that you're flipping houses with, you go rip a piece of crap, 10 or 20 unit, you can still buy it 100% levered or 90% levered.
I don't even think they had to go learn that space. I think they just keep those pieces that they have. They create the equity. They're paying for themselves. They slowly cash flow.
And then what, 1031 out of each one into a bigger project?
1031 into any apartment complex, because now they're 3 caps and 4 caps and you can just trade.
That's just a mindset thing. That's just about looking long term versus short term.
Yep.
They're not building for the future today. They're building income.
To me, you can do both, because I don't get it, because I feel like you can
stop trying to turn an unreasonable person into a reasonable person.
Or they might just not be there. Just like it took me 3 years to get you to decide that you should broker bigger deals instead of selling houses. You couldn't do the math.
You were being unreasonable.
Yep. A different vacuum of conversation, but it applies.
Wow.
Not everybody can see what you see.
Yeah, life gets so easy when you just let people make bad decisions.
You might be able to help them see the logic in your thinking, but they may never be there to where they can think in those terms. And so, I mean, we all have different models. There's probably people looking at us and what we're doing. I have people email me and go, guys, you got to buy somewhere in Ohio because you're stupid for buying in Oregon. Like, you could be cash flowing hundreds of thousands of dollars a month if you did what you did out here. And I'm like, sure,
maybe
I like that. Yeah. However, I live in Oregon. I understand Oregon. I have a property management company and brokerage in Oregon. Like, Ohio is a whole new world, and I don't have infrastructure. I don't know the market. I'm not necessarily buying for cash flow because I'm looking to grow equity. Like, I'm an appreciation buyer. So, like, everybody wants something different out of real estate. That's what I want because that's how I was brought up. And I would love to have some cash flowing real estate. I'd love to buy in Ohio. But to me, it seems easy to go, you're already doing it in Oregon, go do it in Ohio. It's not that easy. It's not that easy for a flipper to go, I'm just going to hang on to some of my units, figure out how to get perm financing, figure out how to do cost seg, figure out how to save money on tax. I mean,
it's simple. It's not easy.
It's not
simple. Because you just look at it and it's simple to you. What's hard is changing your mind. That is the hardest thing. People pay you to give them good advice so they make a bad decision. I see this. Like, the running joke when I was coaching was, should have listened to Mike, and it became a running joke. And I just saw someone recently, they're like, yeah, I should have listened to you because it's cost me fucking huge by making my own decision when you clearly pointed out that maybe this is a better decision.
They had to pay their tuition.
So it is hard to change your mind to make proper decisions. That is what you're struggling with.
I will say it's much easier to not do something that somebody tells you not to do than it is to do something that somebody tells you to do. And so from the perspective of like changing your business, it's like, dude, that's not the business I run. And so keeping 5 rentals and figuring out how to manage and cost seg them and like
They're
meeting with
asking how to own a portfolio.
Yeah, it's not easy in their mind. Like they don't understand.
That's
And
the
so
easier
what's
option than getting
easy
into apartments.
what's easy is just buying a 10-plex with the income that they've already created in their mind. And it's this like, but it's so much easier when Gabe is just like, don't do that thing. It's like, oh, I should probably not do that thing.
Mm-hmm.
That's way easier. And so if like, I don't, maybe frame it different. Say,
That's great. That is
don't
great.
sell.
Yeah.
Don't sell 5 of your units a year. Just figure out a way to not sell them, and then after that, maybe the cost segging.
I mean, I
Even
don't
ask
care
me a
if they
question.
do it or not,
How
but-
do you not sell 5% of your inventory per year?
Yeah.
2%.
Yeah. How do you
of your
not
inventory?
do that?
Yeah. How do
just
you
don't
not
sell it.
Yeah.
Don't sell it.
Yeah. And
Yeah.
then let them figure out the answer
Yeah.
to that.
Yeah. As opposed to do this new thing.
Exactly.
I like
In
that.
Trevor's mind, every time you sell something, it's like a loss.
Because he's a baby.
It's like-
he doesn't understand the
He
value of
wants. He wants to
Just a
hoard.
little baby.
He's a real estate hoarder, and so every time you get rid of something, it's like no.
This is
we
where
could've
Paul
found
is
a way to
bad
keep
for
it.
him. This is where Paul is.
No,
just-
he was already Paul.
He was already Paul before he met
That's what I
Paul.
mean. Paul just emphasizes that mindset he needs to get out of.
Yeah, Paul is.
I will till the day you sell. I'm going to tell you you're making a bad decision.
I will say this: Paul Curley, sell is a 4-letter word. We were never going to sell anything. Paul has more properties on the market today than he's ever had in the history of his
Got to
career.
buy more ranches.
Why the
He
fuck is he choosing
he
this
is
market to
selling-
become a seller?
He
Oh
is
my
selling
god!
in a down market.
Choosing is one way to put it.
And it's all these little pieces that he had that's floating around. He forgot about. He's got a bunch of equity in.
I mean,
and
that's
he's out
just-
playing and buying ranches
Yeah.
and horses and cows and doing all of his stuff. And
He's just reallocating. He gets to reallocate.
But I mean, he should have been selling all this stuff.
see, if
3
you
or 4
sell
years
along the
ago.
way, you don't have to reallocate in a bad market.
So 3 or 4 years ago, I was telling Paul, I said, if there's ever anything you've ever thought remotely you might want to sell,
Now's the time.
Now is the time to do it. He couldn't hear me. He couldn't hear it because he didn't want to, because things were good. There was enough cash. Things were going well.
Listen, Trevor,
and he
listen to
could
this.
not hear it.
Look at Paul's portfolio and look at Gabe's portfolio, though.
Yeah, time, dude. You can't just say that and not throw in the factor of
No, no,
time.
no.
The best advice
Look how
from
Gabe
Jack
built
Miller.
his portfolio.
The best advice from the best educator ever to be in the real estate guru game of education game was sell off the worst 10% of your portfolio every year. Just upgrade your portfolio.
Yeah, that's fair.
Just turn your
But-
bottom 10% into your top
That's
10%.
different.
Bottom 10% into your top 10%.
That's trading. Trading
That's trading.
That's
Yeah.
selling.
via a trade.
If
Yeah,
you're- if
okay.
you're
Frame it
upgrading
as a
your
trade if you need to frame it as a
I'll
trade.
trade. We can
Realizing your equity and getting rid of a bad asset is an amazing thing. It happens through a sales transaction that you can keep in your portfolio
Hey, quit
through a
saying
trade.
that.
Jesus, this guy. We do the same thing. We get caught up on stupid little nuances of words.
I will say swimming in depreciation and having loss and that sort of thing makes it fun when you do want to sell something in your bottom
Yeah.
10%, because you can just sell it and not have to pay taxes because you've got enough depreciation. You're like, hey, I need a few $100,000 out of that one. We'll just sell it.
Yeah.
This is true.
Don't have to worry about it.
Very true.
Hey, so wait, if you pay for something for your business from your personal account, do you get to write that off on your taxes?
It doesn't matter what accounts anything comes out of. It's just how your tax return is filed.
Exactly. You report it.
If you're a good business person, you should probably keep your accounts separate.
Yes.
And handle that.
Not
in a
even
different way.
probably. The only
but-
reason to have an entity is to keep your account separate, and if you don't, that entity is worthless in the court of law.
Because if you get audited, you're
But
going to
if
have
you
to
have
go, oh,
to-
that expense was on this different
No,
card.
I'm
No, when
saying
you get sued, your entities are just for your liability.
yeah.
So if you get sued and your finances are not separate, they piece your veil and your liability protection's gone.
Wait, I was just saying, like, if you have to make a contribution to an entity.
Oh, you can do that from your personal.
Yeah.
That's what I'm saying. Yeah. So if you make a contribution, is that like a write-off?
No.
Can you write that off?
No.
It's an investment.
Okay, that makes
No.
sense.
I mean,
it shows up on your.
You could lie and send it from another entity and say it was, something other
An
than
expense?
contribution. Yeah.
Okay.
I mean, I don't know.
That makes sense.
That's just tax fraud, or I don't know what it is.
No, we're not doing that. I was just wondering. I was asking a
You
question.
can write off loss. You can write off depreciation. You can write off expense.
Okay.
But giving yourself money from one entity to another is not an expense.
That's not okay. That's what I was.
just-
Yeah.
It's
that makes
Mike's
sense.
favorite thing,
That makes sense.
reallocation.
That makes sense.
It's the best word in this
I
world.
used to have money in this account. Now I have it in
Well,
a
I was going to
different
say,
account.
because it kind of just feels like I have less money, when you make a contribution.
It is weird to think about that because you end up with all these entities and all these bank accounts all over the place.
Yeah.
And you look at your personal bank account as that's how much money I have.
Yeah.
But you don't really think of it in terms of.
And then you sell
but
your other bank accounts.
All my properties
It's
have
like-
reserves and all these businesses
Yeah.
have operating money.
Yeah.
And like, there's more money than what's sitting in your personal account.
Yeah.
But you don't look at it that way because we're just, it's like I want to know what's in my account so I can go spend it.
Yeah. No, I can't frame it.
And isn't that why we're all here? Because the only thing money is good for is spending. So if it's not in my personal account, it doesn't really count.
And you
'cause I
have to
wanna be able
spend it all because you
I
got to
know.
give it all back at the end of your life.
To who?
It's not yours. You're just a steward of it while you live.
That's true.
In the
Can't
famous
take it with you.
famous words of a rapper named, he shall not be named, but he said, "When I die, put my money in the grave." I'd like to live by that.
I want to be buried in my Hummer.
I prefer the Macklemore.
I'd like
you
to-
die twice.
I'd like to be. I haven't heard that one.
Yeah, first time is when you die. Second time is when last time someone says your name.
Oh, I have heard that, but not from Macklemore. That's depressing.
No, it means
On
you
that
you
note-
don't want people to not say your name. You don't want to die twice.
All right. Are we going to wrap this up?
Yeah.
Did we solve all the world's problems?
I
Do we know-
digress.
do we know where the market is going?
Hopefully, we just solved Trevor's problem.
Actually, Mike said that World War III
So
was starting.
it's a great
Yeah,
time
it
to
could
be
be
buying.
starting.
Yeah, there's some weird things going on. It could be a great time right now to be buying commercial, but Mike's on the sidelines for residential for everybody listening.
no,
Mike says buy
no.
residential.
I'm always buying. I'm just buying conservatively.
You're much more conservative.
I'm not just going all balls to the wall.
We're to the wall because we've got sellers that are willing to cooperate with us.
yeah, I'm buying liberally
Yes, you are.
right now. Yep. Trevor is always buying liberally. He's grinning.
Are you okay, Trevor?
I just want to end this podcast.
Well,
now.
we're not going to end it before we say happy birthday to Trevor. Trevor turned 29 this week.
No wonder he's depressed.
He's going to be
He's at a
30 next year.
podcast studio instead of playing pickleball.
This
For
is
you
No,
guys.
he's 29. He's like 1 year away from the first death
Year
knell
of being
life.
old.
Yeah.
His
Yeah,
first of
it
3
will-
deaths.
He'll no longer be cool anymore when he's 30 because he'll just be like every other 30-year-old that went out and built a big real estate
Yeah,
empire.
that's
But I
true.
will say that I have to get back at him because he opened up one of your podcasts when I wasn't here talking about how I almost
Wait, you
crashed
got
the
to
boat.
open the next podcast. No one listens.
Oh
to
my
that.
goodness!
No, we
Wait.
can't go on that rant. That was the most boring intro
No,
to
have you
ever
heard what
podcast
happened?
ever.
Hold on, tell them on the next one.
No. Yeah.
Okay, guys, stay
Listen to the next
tuned.
one.
Stay tuned for the next episode. We're going to tell you what Trevor did
Oh shit!
for his 29th birthday.
On it.
Now he's depressed. All right, guys, we love you, Deal Junkies. Please share us, subscribe, and we'll see you next time.